Good morning. It is the 20th day of July. Sorry I was late. I got COVID and had to lay around at the house for about a week or so until that got past me and tested negative. Hope everybody's having a good summer. It's beautiful times, a little hot. Would like to go over just in general what's happening again in our markets. It's been quite a ride. And so right now we're experiencing more volatility. I'm not going to make a whole lot of predictions. I don't think that it's over, but then again, who knows? So let's just look at what is. So I'm going to go to the charts. That's what this is about. And we'll talk a little bit about what's happening currently and what has happened year to date. So when we look at these markets and we go over the point of time, what we're seeing is this. January of this year was a market top. The market has declined since then. We are making lower highs periodically. So will this be another lower high? I don't know yet, is the answer. But as we look at this, you can quickly see that depending on what measurement point we're looking at, this market has been down over 20, we'll call it 23%. Just to make it an easy number down here at the bottom right there. And, right now we're down more like 18%. Yesterday we had like a 700-point rally on the Dow. It was a big rally. I doubt, honestly, that's people buying stocks in earnest. That's probably more of the people that short stocks closing their positions. When you get those massive rallies in front of major economic announcements, usually they're just playing with you. I hate to just say it. So anyway, doesn't matter. What is. We're down about 18% year to date on the Standard & Poor's 500 index. Now, it's been interesting. People talk to me and say, how is it doing? It is nothing. This is 500 and some odd stocks, companies in the United States. And so it is a big thing. It is not a small thing. So when you're looking at the S&P, just in general, you're buying Kraft, Exxon, you're buying CSX Railroad, you're buying Occidental Petroleum, you're buying Tesla, you're buying Wells Fargo. You're actually owning your commensurate slice of those companies in a broad index like this. So just saying, it's not an it. It's actually a big pile of companies put together in a certain way. All right, so when we look, for example, at the NASDAQ, which is, let me do one other thing here while I'm here. Let's go back 2 years. Now you can see something different. We had this big, massive rally in the S&P 500. A lot of money was created in this window of time, a lot. If you look back to the COVID spike, it dropped way down. 33% peak to trough, took about a month and a couple of days to get there. They started injecting massive quantities of capital into our economic system. It went somewhere, it went to stocks. That's where it went. And so this overkill, if you will, this part right in here, you can kind of see above my poorly drawn, probably inefficient, don't be critical of me, trend line is sort of, okay, maybe this was overkill due to a lot of money trying to find a home. Okay, we're pretty close to on trend right now. So does that mean we're reaching some massive recession where we're going to see things decline substantially? Not sure. I know that a lot is changing in our economy. The supply chain issue has been a problem. The cost of materials has been a problem. The access of materials has been a problem. Labor has been a problem. But, everything has a way of working itself out with time. We'll see. All right. We'll look at the NASDAQ, which is the hot dot place where all the cool guys were. And if you look, again, if I can draw a line well, can't, but if I can, and we look sort of at back 5 years and try to find some sort of normal range. Oh, that's probably your normal range right in there, right on this line. So again, a lot of money. And now we're sort of seeing, how about this for a cool guy comment, reversion to the mean. So it just is. And this index, even with all the hems and haws, is still down, I don't know, 27%-ish, somewhere in that range. But just kind of looking at it and saying, are we way down on a trend line? And we're really not if you're measuring from 5 years back. If you're measuring from 1 year, it looks horrible. But again, 1 year is 1 year, and we're not even done yet. All right, over the pond there a little bit, just looking at Europe, Australia, the Far East, EFI index, if I could type it in there right. What we're seeing again is more of the same. Now, these countries are not as robust from an economic standpoint as we are. We have the biggest GDP in the world. We produce more than anybody. I think the number's 7 trillion more than China. Are they catching us? Kinda. But you can see that these countries, Canada, Europe, Australia, Japan, they're having a hard time making any headway. It's a different thing. They have more debt to GDP, government debt, maybe monetization, that type of stuff. I'm not sure about that, but they don't seem to have the robust growth that we do. So just kind of saying. Everybody's asking me, what about China? Well, here's an ETF you can buy that pretty much just does China. And over the 5-year window, again, it's like, again, all of these economies right now are slowing down a little bit. It's been overkill, and now things are starting to slow a little bit. The index that these guys fall in, along with Russia and India and many other countries that are more emerging, is the emerging markets index right here. I use iShares, but there's others. And again, you can see flat to down. So is there a lot of economic growth? The stocks are not telling us that there is. So read the tea leaves. Bond markets. Bond market, the price of a bond, which is what you're seeing here, is down. The reason, primary reason, most of the reason is that they're raising interest rates, and it's really been a long time since rates have been up to where anybody even paid attention to them. So looking back over a 5-year window, we're down from 5 years ago, and substantially down from 2020. So you can see that as these interest rates increase, the price of a current bond will adjust down because of that. Gold. Gold will save me. Okay. Gold is no longer a currency. It doesn't back the US dollar. So at the end of the day, it's a piece of yellow metal. It trades for what people will pay for it. And this is a way to have access to gold shares through the S&P. They say that gold bar is back there somewhere. I don't know that for sure because I've never asked them for it, but the price of gold, you just move this over one decimal point, it's about $1,595.40, give or take a little bit. That's what an ounce apparently is. But as far as is it in a screaming uptrend? Well, it was up until 8/6/2020 and almost 2 years ago, and it hasn't made any upward trajectory from there, bouncing around, currently in a down trajectory. So who knows? I'm just saying that right now the world's repositioning their assets. Do you want to try to play in a busy field like this because it's moving around a lot? A lot of people don't. We don't. So just make sure that you understand what you're doing, what you own. If you're buying things yourself, make sure that you've identified things that you really like to own and understand, at least over the short term, the next 6 months maybe, you'll probably see a lot of volatility. Doesn't mean it's a bad thing or a good thing. It just means that things are sorting themselves out. So no panic, just it's kind of frustrating when your stuff doesn't always go up. I know that. So bear with it. Things will work themselves out, and there'll probably be some really great days ahead of us. And with that, I'm going to close up. If you need us, give us a call at 336-448-1086. And until next month, I hope you have a great remainder of your July.